Hi, everyone. Good afternoon. Welcome back. Hi, Patrick.
Welcome, everyone. Welcome.
So today we continue the week with another session where we're going to go over our gamma levels, and we're going to focus on our put support. So if you missed the session yesterday, we did our core resistance. Today we're going to do our put support, and then for the rest of the week, we're going to focus on the other gamma levels. But before we get started, as always, we're going to share our risk disclaimer for a few seconds. All right, that's great. And as always, any questions, paste them in the comments. We're going to do a Q&A at the end, and we're going to answer all the questions that you have. But yeah, maybe we get started.
Go.
So first of all, just a quick recap. Why are we talking about gamma levels? What are they? If you haven't followed the session yesterday, basically, gamma levels really are key price levels that are reaction zones where there is more negative and positive gamma based on market option positioning and open interest. Here, what you see in the chart, and we're going to go through this chart as well in a second, is our net gamma exposure chart. You see wide green bars and wide red bars. Those represents the levels with the highest positive and negative jacks, and they represent the gamma levels that will become market reaction zones. And today we're going to go into our put support. But before we go into that, these are the gamma levels that we provide currently through our membership, and that you can integrate directly into your trading charts and trading platform. So today we're going to go over our put support and our put support 0 DTEs. Tomorrow we're going to look at the IVO levels, so the HVL 0 DTEs. Then we're going to go into our 1 day minimum, 1 day max on Thursday. And then on Friday, we're going to focus on our secondary level, which are our jacks level 1 to 10. So they are divided into primary and secondary level. And yeah, we're going to go through them all through this week. And yesterday we did our core resistance as well. All right. So today, obviously, the focus is looking at the put support. So again, we take what you see right here is our net gamma exposure chart that you can find within Discord. And we're going to show you why this level is very important and why it becomes a reaction zone. But first, let's go over what the put support level is. The put support level is a strike price with the highest net put gamma. Here you can see it's highlighted, and here you can see the widest red bar there. So that represents the put support level. It's also the level where there is the most put open interest and put gamma, where investors and hedgers have been buying out of the money put option or selling put option at that strike price. So this brings us to why are we seeing this level and why is that relevant? So first of all, we are now experiencing all-time high in the market. So we need to consider how investors are hedging. So how are they protecting themselves from a potential downside movement? So they do that by buying puts, so buying options to protect from the downside. They could also do put spreads, or they could also do advanced strategies with options like collars, iron condors, cover calls, all of that stuff. So this is kind of like how you can kind of protect for a downside movement. And that's what large institutions are doing. And why is this relevant? Because as we mentioned yesterday, most option transactions are executed by market makers. Market makers are, again, in the business of making money by charging a spread on the transaction, not by taking a risk. So as a result, what you see in this slide right here is how does the market maker hedge based on different option strategies. So if you are long put as an investor, the market maker on the other side is short put, and in order to be able to hedge that position, they need to sell the underlying. So sell whether it's the future, the stock, or the index. And this brings us back again. We're going to show this slide again because it's very relevant. You might have seen it yesterday, but basically this brings us back to the Greek gamma. And this is why they're called gamma levels. And gamma is really a measure of the rate of change of an option delta with the change in the price of the underlying, and it's obviously very key in the delta hedging activity of market makers. The overall gamma exposure in the market can be positive or negative. And why is this important, right? Because as we explained, market makers are taking on a risk by providing liquidity, and they're constantly hedging their portfolios by buying or selling the underlying asset, or by offsetting trades and buying or selling securities. So the overall gamma exposure will affect how they are hedging, and that will also have a consequence on the price action in the market. And this is why monitoring the gamma condition is very important for any type of trader, because it will also dictate the regime of volatility that you might experience throughout the day. Then we introduce basically the concept of positive and negative gamma. We have a lot of documentation on the website. We're going to show you later where to find it. But basically, what we know is that in a positive gamma, the overall market is long options, which means that they are buying more options than selling. So this brings us to how the market makers would hedge in a positive gamma environment. The market maker would buy as the underlying falls and would sell when the underlying goes up. And this is how they kind of like stabilize and they delta hedge their positions. This activity, again, is very important because it keeps intraday volatility low to the low side, and knowing how volatility will be as the market open is also very important for any type of trader, because again, as Patrick mentioned, volatility is your currency. Remember, to be obviously successful, you always need to be on the right side of volatility. So this is very important. On the other hand, if we look at the negative gamma, it means that the overall market exposure is short options, which means that they are selling more options than buying. And this also affects the way market makers would hedge. So in a negative gamma condition, the market makers hedges by selling the underlying when the prices falls and going long when the prices goes up. And as you can imagine, if the price were to drop, this creates more volatility in the market. And when we are in negative gamma, we can expect large price swings during the day. But that doesn't mean that the price will just dramatically drops. It means that you would see very big swings throughout the day that could be on the upside or the downside, but very, very strong moves. So when there is significant put open interest, the dealers or market makers, they need to hedge by selling the underlying assets as the price decline. So again, this why does it bring volatility? Because it creates kind of like a feedback loop that amplifies the downside moves, right? And this is what the negative gamma environment regime represents. So where can we find this information? And here we go back to our platform, our tools. So here you have two ways on where you can see on a daily basis where the market is. We have our liquidity snapshot command that shows you exactly if the gamma condition. So in this case, we see the QQQ. We are in a positive gamma environment. Or you can look at the matrix and you can see the total exposure and you can see if it's either green or red. So if the JAX is positive, that would mean that we are in a positive gamma environment. If the JAX is red or negative, that would mean we are in a negative gamma environment. So you can actually look that up very easily. Let's actually go into Discord now and just very simply type my liquidity snapshot command and just type any companies. So here we have Tesla. We see the gamma condition here, or we can open up the matrix on SPX and we can look at the total exposure right here. We see we have 435 million of positive JAX that also is highlighted in green. So here we are in a positive gamma environment. Okay, now we're going to show you how you can trade the put support, and then we're going to talk also about the zero DT levels, right? But why does it become a support level? So as the price of an asset moves towards the downside, puts start becoming, so especially puts that were previously out of the money, start becoming at the money or in the money. So they start actually having value. So investors that really had been buying those options for protections as a hedge to the downside are going to then change their positioning. So they're either going to monetize those options or they're going to roll those options to the downside depending on the sentiment. But why does this level become a support? So the put support level is a level where there is more put hedging activity. So the market maker is usually shorting when we touch that level. And as the spot get closer to those puts, those puts actually go into the money, right? So they start monetizing, becoming profitable. So as an investor, imagine if you are holding those puts, and obviously those puts have an expiration, you are either going to do two things. If you really believe that the price can go actually much lower, you might keep those puts, and those puts can increase in value, or most likely you're going to monetize those puts. So you might sell those puts and maybe buying lower strike prices, more out of the money puts. So you're basically closing those options contracts. So let's imagine that we're monetizing those puts. That can give the market a technical upside, as the market makers that are now were now shorting those underlying or based on the delta of those options are now closing their hedges because they don't need to hedge those positions anymore, right? So by closing those short positions, they are going long on the other side, and that's when you see those technical move and those reactions close to the put support. So if the investor is closing the put, the market makers does not have to stay in the short to hedge the put anymore, and they can now adjust their delta, and that can bring the market to the upside. Here we have an example from yesterday, I think it was on NQ, where the price reaches the put support 0 DTs in a couple of times, and as we can see, basically it doesn't break through that level, and then we see like a change in trend and a massive upside in a couple of occasions there. All right. The other way of trading the put support, similar to what we've seen with the core resistance, is by using it as an inflection point for an accelerated downside. This typically happens when we see a strong bearish sentiment in the market, and investors are actually not closing those positions, but they're actually rolling it to the downside. So basically, they buy more out of the money puts to protect their exposure at lower strike prices. Now, if those hedges are open low, that can push the put support level towards a lower strike, and could become another bearish force as the market makers need to then hedge those puts as well. All right. So within the levels, as we saw, we have two levels. We have the put support and the put support 0 DT. Here we can see that basically you can find the 0 DT options by running our NetJax multi-expiration chart. On the top left, you would see the 0 DT option for SPY, and here you can see the highlighted by the arrow, the put support level for that expiration. And we're going to talk about the 0 DTs level in a second. But basically, why are we looking at 0 DTs? We talked about it yesterday, so we're going to just spend a few minutes today as well. But basically, the difference between the put support and the put support 0 DT is that the put support level just looks at the full option chain, while the put support 0 DT only would look at the option chain for that expiration, the one highlighted in the red square right there. And in the case of indices, ETFs like SPY and QQQ and futures, those would represent the next day expiration. In the case of stocks, the put support 0 DT would represent the expiration or the weekly expiration as of Friday. So if we look at, for example, the put support 0 DT for Tesla, that would be looking at the expiration of this Friday for that option chain. All right. So let's go back to why these levels are important, and we talked about it yesterday. But basically, the closer the option is to the expiration, and the more sensitive the delta is to small price changes, and that could lead also to the big change in gamma. So we see that short-dated options, typically zero DTEs or weekly options, they are they have a higher gamma sensitivity, and as the option again approaches the expiration, especially the at-the-money options that have typically the highest gamma, they can be very sensitive to every change in underlying price. So the gamma and the delta of the option change really quickly, and as a result, on the other side, the delta hedging activity has to be really adjusted, and that's why we see typically a lot of intraday movement, especially with the zero DT levels. With the zero DT options, again, because we have less time to expirations, large institutions, traders, and market makers need to continuously rebalance their hedges due to the highly volatile delta of these expiring options. And that can cause really big technical moves in the market. We see an amplification of volatility, especially if, for example, there is a catalyst during the day, maybe like an economic event, and the options that were previously out of the money start becoming in the money. Then we see these large intraday moves, and we see a large activity of hedging, and that's why when we see those large kind of movement as well. And again, we talked about it yesterday. We could also look at potential squeezes. So if those zero DT options are monetized or are becoming the money very fast, we could see those gamma squeezes, and we talked about it yesterday, and you could see exponential price moves throughout the day. And then finally, pin risk. So again, we talked about it again during the core resistance session, but it could be that if there is a large enough activity on zero DT options, we could see the price really being pinned, meaning that because of this buying and selling pressure, the candle will stick to a level throughout the day, maybe for hours or minutes as well. So that's very important. All right. Before we go into the example, Patrick, let me know if you have any question on your side.
I think we covered yesterday everything. We were speaking about the pin risk. We have also some video in the library where we were speaking about the gamma squeeze. I think one point what the people can curious about is there some point or some good nugget for you see that there could be possible an increase of the hedging activity? So if you're looking to the NetJacks or if you're looking to our metrics, are there some signs where we can think about, now we can think about there could be a good hedging activity where we can take advantage of?
Yeah, I think actually I have some examples. So I think that we can answer this question in the next example. But basically, if we go back to our platform, I think the most important part is really looking at the change over a few days. So looking at, for example, if you look at the matrix right now, we can always go back in time and see how things have changed. So what you want to monitor is, is the gamma flipping from positive to negative, right? Is the put support going up or down? So is the put support, so if we look at, for example, our key levels or our NetJacks, what you do want to monitor is, here you have your put support right here. You want to see if day by day the put support is staying in the same level, or if it's going lower or higher, because that can also be an indication of potential sentiment. So if the put support is moving higher day by day, that means that investors are really choosing higher strike for their hedges. So that means that maybe they're not as bearish as they were a few days ago, and that could be a good sign for the market. But yeah, we're gonna show you some example as well.
Same is also when we're speaking about call resistance from the last call, if the call resistance goes down, they are no more bullish, so strong.
Yeah, exactly. It's the same principle.
All right.
All right. So let's go into some examples. So first, let's actually look at what is happening right now, right? So the market is at all-time highs, right? So there's a very big bullish sentiment in the market. We're going to start this week with the tech earnings. Tomorrow we have Tesla. So obviously very important signs. The market overall seems to be bullish. You see it from the net jacks. You have very wide like green bars there. But at the same time, we actually see an increased participation in out-of-the-money calls, um, and we see it from the green, red bar, white bar. But we also see an increased activity on puts, especially out-of-the-money puts. And the reason is very simple. Like we are at all-time high. Like large funds have made like great returns this year just by looking at the stock market. But we are coming to the end of the year, right? Remember, we are at the end of October, beginning of November. Those are typically, and think about after Thanksgiving in the US, the market tends to kind of like come down. The traders are kind of looking at the next year, so they are really trying to do one thing is like don't lose money, right? And how you do that? You do that by using puts or like by covering yourself, protecting, hedging. So we see here that in this chart, you see there's like a development of put activity at out-of-the-money strikes, both on the SPX and the QQQ. And obviously, this is a sign that the market is still bullish, but the funds are actually looking at protection because they don't want to give away their profit.
And I think we get a good question from Dan Trader. I think we can bring this now in because it's a good one for now.
So are there times of volatility when the gamma of zero DTEs are more sensitive than others? For example, weekly expiry, end of the day. So I think we're going to talk about OPEX. So option expiration is definitely a very, very important event where zero DTEs are becoming relevant. But I think also when we are in a negative gamma environment, as we mentioned, the volatility is increased because of the way they're hedging. So if we are touching zero DT levels on a negative gamma environment, that could also be bringing in a lot of volatility or increased volatility. Let me know if that answers your question, Dan. All right. So then, we saw basically that that basically overall the market is in a bullish side, but we are also seeing an increased amount of protection. So now we can overlay that analysis with our skew chart. And here what you see is the skew, 1 month skew of SPX and QQQ. So what is the MenthorQ skew? What does it represent? So we are looking at the difference between the implied volatility of the 25 delta puts versus the 25 delta calls. They are typically, this is called the risk reversal skew. And why is the 25 delta a relevant information? Because they are typically out of the money calls and out of the money puts. So you want to really monitor how the implied volatility changes, because that can also be a signal of what the market is doing. So what you see in this chart is really that on the SPX, on the left-hand side, the call implied volatility is way higher than the put implied volatility. We see the chart being at the bottom, right? So the lower it is, the higher the call implied volatility is. But we see a different picture on the QQQ, where the implied volatility of 25 delta puts, it seems like really much higher than 25 delta calls. And the reason is really simple. We are starting to see the tech earnings. So most likely the market is hedging for those. We have Tesla. We're going to have the big tech very soon. So here you can use those charts to understand, okay, where is the market looking, how they're positioning themselves, and what are the things that you should be paying attention to. Next, again, going back to your question, Dan, we need to monitor very closely the gamma, the delta, and the open interest that is expiring. So here what we have is our matrix. You can see the percentage of JAX and DEX and OI, so open interest, that is expiring at different expirations. So here we have our daily expiration, but we also would have our monthly. So the OPEX option expiration is the third Friday of the month. And why is this important? Remember, once those options expire, the hedges do not need to be there anymore. So like if we have a lot of gamma expiring on a certain day, after that expiration, market makers do not need to hedge on those options. So there's a release of those hedges. And that's why especially OPEX becomes very important because we want to monitor during OPEX or after OPEX how the market is reassessing. So for example, in the case of put support, we want to monitor how the put support changes after the OPEX. So and that can be a leading indicator of sentiment, because if, for example, after OPEX, the put support is lower than it was before, then it means that the market is really rolling down the strikes, and maybe there's a negative sentiment there. Same could happen if the put support is towards the upper side. So like always monitor the third Friday of the month OPEX. Never stress too much about it. It's a very important event, and also monitor as well the daily and the weeklies, especially if there's a large percentage of gamma expiring. Like for example, today we see 20% of gamma expiring on the 22nd of October. So that could be a very important one.
Also, I will add something to the graphic, Fabio. I would also say if we have a daily expiration, I will look into this if we have any major events happen. So we have, for example, Tesla earnings. We will speak about this later. It will be starting tomorrow. We have maybe economic events. So look to the expiration date. If you see some high activity on the expiration date, look into the economic calendar. Is there some event, what has happened where people battling on, or is there some earnings happen? So we have now earnings season. And don't forget, we have very soon election. So this is something what is at the moment also very important to look into is when it comes to the expiration dates. Only as a small information. OPEX is very important, but also at the moment when we have earnings season, election date, look to the election date. When we have the election, what has happened, how people changing his position before election, after election, and all the stuff. So the many stuff came now together.
Yeah, absolutely. And then if we go to the next slide, we provide also systematic models. So this is a screenshot from our CTA model on the NASDAQ. So also looking at what CTAs are doing, especially as we approach those put support levels, is very important, because most likely those levels will act as trigger points. So if a put support level is broken, it could mean that also CTA's funds are actually short in the market and potentially accentuating the move. So looking at this chart helps you understand, okay, have the CTAs been buying the NASDAQ? Have they been selling the NASDAQ? And how can that affect the price of the asset? And then finally, this is kind of the last example. This is another model that we provide, and it's called the IVOI model. It stands for implied volatility times open interest. And why is this important? Because the bars represent the strike where there is a higher implied volatility and open interest. So in this case, for example, we see, and actually let's go into the chart right here. So I'm gonna show you. So we open up our IVOI, and we do it on QQQ. Open up this chart, which is the same chart. And as you can see here, this is our put support level right here. You can see it up here, 485. Let's actually scroll. And it's this level right here. So we see some wide red bars right here. But if you scroll down, look at this section right here. So there's a lot of open interest and implied volatility at the 479 or 480 level, at the 475 level. So that means that maybe the market is already protecting for a potential downside. So they are buying and increasing buying, and the implied volatility of those strikes increase, and also the open interest is increasing a lot. So also monitoring kind of these can help you understand, okay, what happens if the put support gets broken? Maybe those are the next target that I can monitor, or those are the next strike prices. Let's see if you guys have any questions, and then we'll do some practical example from today, actually. So another thing that we have as part of the membership is our option screeners. So if you go back on our Discord, this week or last week, actually, we did a really good session with one of our users, Simon. He really showed us how he's using actually the put support screener itself to build a series of basket of stocks, and how he's been very successful in that. So you can find the video right here. But if we go back on the screener, so you can find the screeners within your account dashboard. You can click on screeners right here. And then you scroll down and you have our put support and our put support 0 DTE screener. So click on this one, and we see some good example, and you saw Rivian, DraftKings, we see some DIA, and then we're going to go into the chart and see what happens. So we start with DIA. So these are the levels from today. So as you can see, price open lower, went all the way almost at the put support level, and then kind of rebounds to the upside. So as we always say, always think about this level in zones, because this is like how the market doesn't actually react to the tick level, but like always think about it as in zones. And here we see that basically we were a few cents away from the put support, and the price kind of like jumped all the way up after that. Then we saw, for example, from the screener, we saw Rivian. So if we go back to our screener, we see Rivian and DKNG. So here we can see basically again, we have price opens, touches the put support, goes all the way up, retest right here, and then we see a massive move to the upside. Let's do another example, DKNG. Same thing here. Price opens, kind of like almost at the put support level, then move to the upside.
Can you go back to Rivian for one moment? All right. Here's something what I was seeing when I was observing all the time the levels. For me, it make a huge difference if we see put support or put support 0 DTE alone, or we have also put support and high vol 0 DTE and high vol together, or we have put support and gamma vol together. If we have two levels there, like put support and some other gamma level, who is also a major one, so then this is much stronger than the single one. And especially if the high vol is also there. Sometimes we see that put support, high vol, 0 DTE, high vol is together. So this is a really strong one. I cannot tell you why is this strong, but every time when I see something like this, that we have this together, I be really careful with my trades, and I always looking for follow truth. I'm more patient with this because this is a really strong one. And also if you see put support and a little bit higher or a little bit down the high wall level. So this means for me most of the time a really strong area where we should be really patient, really careful. But if the stock is moving in some direction, what we were seeing today in Rivian, this is a really good one where we can ride the wave.
And then we can, if we go back to yesterday, and what I'm gonna put is the levels from yesterday on NQ. We actually saw a very strong activity right here. So those are the gamma levels from yesterday here. And as you can see, basically, again, big reaction in two occasions right here where the price really changes the trend and just moves all the way to the upside and then tries to break it again, moves back again right there.
And this is exactly what I mean, Fabio. So we have two levels there. We have not a single one. We have now put support and put support 0 DTE there. So yesterday. And if we're looking to the call resistance, we have call resistance there. We have gamma wall 0 DTE there. And we have call resistance 0 DTE there. So we have not a single one. We have a combination of many other ones.
Mhm.
And also when we're looking to the put support and put support 0 DTE where we speak now, we have above high wall 0 DTE. So if we see some setup like this where everything is together, everything is merged together, so this is most of the time areas will have strong impact, strong magnets, where we should be really careful. But if we're getting the move, we get a strong move.
Mm-hmm. Yeah, makes sense. All right, I think now I think it's time to maybe open it up for some questions. Let's see if we have any.
I have some questions. People asking always, did we have some backtest data about the levels, put support, call resistance, or is there something what we have or provide in the future? Do you have some outlook about this?
Yes, we don't have a full-fledged back test on the put support. We have it on the 1-day max and 1-day minimum. We will talk about it on Thursday. We are working with some quants who are now testing the data. So obviously, hopefully, we will have some really interesting results there. But we're also developing our own back testing as well. So yeah.
Perfect.
That's a good question from Ian. On the daily matrix, is there one that shows the last 5 days? No, we don't have it just because of space. But what you can do basically, Ian, is if you go on the matrix, here what you can see is the 1-day change in JAX and DEX. And obviously, it's just a matter of space. So it's not that we don't have the data yet. It's just a matter of having the space in the chart, in the table.
I think one question is maybe for me. Can you explain what it means behind being careful? So what I mean with being careful is that you should be waiting for really follow truth if you would be enter in this area. So why I mean is every time when I'm observing this and we have areas like what we have now on NQ. Let's take a look to NQ. We have now call resistance 0 DTE and gamma was 0 DTE. So we have not a single one there. So every time when we have something where it's moved together, this is for me a really strong sign. So this means it's not easy to go and choose this. This means, so if I would be long there, or if I will be battle that we're getting some momentum there, I would be very careful because we have now two really crazy levels. We have the gamma wall and we have call resistance there. So this is what I mean. So this could be a really good take profit area. Be careful if you re-enter there. If you won't be short there, also wait for follow through. Wait maybe for a better area. This is a crazy one. It's not so easy to trade. And then we have put support 0 DTE, and we have the high wall levels all there. So we have high wall levels and put support there. So this is also a really crazy area. So I will not battle on this. So it could be very hard to do this. And this is something what I mean. If you see setups like this, be careful, waiting for follow through, and trade always your A plus setup in areas like this. Because we get many calls, Fabio. Remember, where people saying, "Hey, I was seeing put support. I was going, I don't know, short, long, whatever, but I was stopped out."
Yeah.
And most of the time is because first you was having not some small stop loss, because if you're trading the NQ was now on 20,650 or 600 points. So, and you give them only 20 point stop loss. I don't know. This feels like you're giving NVIDIA 2 cent stop loss. It makes no sense.
Yeah. Yeah.
So, and for this reason, if you see levels like this, where you have merged something together, rethink about this. We were speaking about in our academy. We was giving you the teaching about timing, location, and setup. If you see a merge area like this, is this now the right timing for you to go into the market? Is there a much better setup? Location, ask all the questions, timing, location, setup, ask this, and then going through this.
Yeah.
Don't go blind in areas where we have crazy areas where crazy strong. It's making most of the time no sense, especially if you're not so experienced with these areas.
Yeah. We have another good question from Ian. Can you explain again about what the market maker does in positive and negative gamma environments? So let's go back to our slides. All right. So here, Ian, basically, this is kind of like the way it kind of works, right? So obviously, it's the delta hedging mechanism is obviously more complicated than this, and it's but this is very to simplify it. So when we are in positive gamma, the market makers are going long when the price goes down and going short when the price goes up. So by doing that, the volatility on that environment, so by doing that kind of like delta hedging, tends to be low because this type of hedging stabilizes the price, right? But if we then go to a negative gamma environment, the market makers are shorting when the price goes down and going long when the price goes up. So you can imagine that if the price is dropping already, you also have another force caused by the market makers that are basically accentuating the move. So that means that obviously the price could actually fall very quickly, but it could also mean that there's like then a very fast kind of like movement throughout the day. I hope that answered the question. So let's go back here. There's a question from. So if it bounces from put support 0DT and hits core resistance 0DT and comes back to put support 0DT, is the level still a strong support level? The answer is yes. And always think that options have an expiration, right? So the put support is really translating the option activity. And as we move closer to the expiration, the sensitivity of those options, as we mentioned, increases, right? So if there is a retest of that level, then suddenly, those hedges need to be put in place. So yes, it is a support that is still valid.
And also, it's a good question. Looking to the left side, understand the big picture behind from the levels, and then ask you the question on your side. Is this now a really strong area where the put support is showing me on the bigger picture? And last but not least, if you're looking to put support 0DT, it's a round number, 2,500. And also call resistance is a round number, 2,600. They are always strong. They always are better on it. But what helps to understand if this is a strong area or not, looking to the left side, go to the 1 hour time frame, looking to the left side and see was in the past there some area where we're getting strong support, or did we getting strong resistance? Did we pull back from something, or how long it doesn't take that we break this truth? So most of the time you will see the same picture again.
Yeah. We have another questions about gamma condition. So how does positive gamma environment happen, and are most participants short options? And thank you for the question. We can actually go back to the slide. So the answer is yes. So negative gamma equals short gamma or being short option. So if we are in a negative gamma environment, that means that the overall market is selling more option than buying. So therefore, we see kind of like a negative, a complete negative gamma condition. And the way we look at that, we have actually created the models that, especially if we go into our matrix right here, we are taking all the expiration dates going all the way through 2029 in this case, and we calculate the net gamma exposure right here, so JAX, and we show you if it's positive or negative. So by looking at that, you can see if you are in a positive or negative gamma environment, and you can also go back onto our snapshot, and we can quickly see it right here. So you can look at either in the matrix, or you can look at the snapshot and you can see if you are in a positive or negative gamma. And that's kind of like the first thing that we do in the morning when we come into the charts. We want to see the change in JAX. We want to see the change in gamma condition. Like, for example, if we go into our screener, we have a highest negative change in JAX. So we want to monitor basically where is JAX coming out, where is more negative JAX being piled on. So we see like SPY, for example, we have an increase in negative JAX of 253 million, right? But we can do the same with the positive JAX. So where is more positive JAX being accumulated? So we saw NVIDIA, we saw yesterday there was a massive move in NVIDIA, Amazon, preparing for earnings, like, MicroStrategy and so on.
But maybe I will share again, Fabio, that the people, the Wolf and the other people who are asking the question, that they can understand it a little bit better, what I mean with looking to the left side. Here we go. Let me know if you can see my screen.
Yeah.
All right. So now we have the NQ here. And what I mean with looking to the left side, so here we have call resistance today, but what was this area, not the level, not the name call resistance, but what was the level here doing the red line? So we was coming down from here. We was testing this first one time. Now it's the second time. And if we want taking the long here to the breakout, we have to double sync this. It's a call resistance and gamma was UTTE. So this is a merged level, and this is only the second test. I don't know if this is now a good idea to take the breakout here. But of course, it's no financial advice here. And also, if you're looking to the put support where you was asking, is this a strong level? Looking to the left side, what was happened the last time when we came to this level? So this is the green area here. What was happened? And then learn and understand the big picture behind the levels. You have to understand first the levels, what we were showing here, call resistance, put support, one-day max, high wall, all the stuff, they came from the options market. But if you place this now basically on the future chart like NQ, and you are a futures trader and not the options trader, then look to the big picture. What are the levels are telling you? And I see it really clearly what the levels are telling me. I see exactly what one-day min is meaning to me. I see exactly what high wall is meaning to me. I see it really clearly on my chart. And this is one guy where we was talking with, they was telling us, hey, this is a really nice and accurate support and resistance system. It is not, it's based on data, and it's not subjective, and I'm not drawing this. It's all based on data, and they're giving us a clear overview about how we can read the market. And this is so important for us. Now for us, it becomes much easier to find out good entry points, good exit points. We can now look into our A+ setups. We can now look into our playbooks, and we can think about, okay, how we can bring MenthorQ now in my system, how I can play with MenthorQ my playbook. And this is all what you can do if you be a futures trader and not an options trader. And that's it.
Yeah.
If I call this simple and easy, I will get many re-questions. But at the end, if you bring this in your playbook and this matched with your A+ setups, and you follow this simple and easy rule, timing, location, and setup, and you go for one good trade and then again one good trade, I will tell you it will become much easier as before for you. All right.
Yeah. I think I can take the question here from Wolf. So again, if we go back to this slide, negative gamma doesn't mean that the price is going to drop. It means that the price will be more volatile. So it could also be that you will see big swings throughout the day. But it doesn't mean that because we are in negative gamma that the market is going to drop. It just means that the volatility will be higher. So yes, that's how you need to read it. And as a trader, volatility is your currency, so you want to be positioned so that you can capitalize on those moves. Basically, that's the idea.
And I would also be, I was talking with someone also about this when we're speaking about positive gamma and negative gamma. So we have to really clear about thinking about, so what we are. We are options traders, or we are futures traders, or we are stocks traders. It makes a completely different if you're speaking about positive gamma and negative gamma based on options, because there's a different calculation if we be in different areas. But for us, if we're trading futures, if we're trading stocks, the positive and negative gamma, they can giving us maybe an idea. But what we are doing now is, Fabio, correct me if we're wrong, but at the end, we're giving open interest, correctly? We calculate this today. We calculate today at the end of the day for tomorrow, correct?
Yeah, it's not just open interest, but yeah, open interest is one of the measures that we look into. Yeah.
Okay, perfect. But think about, so now we have some earnings. We have maybe Tesla earnings, and then we will open 2 or 3% higher in the NQ. So it is now positive gamma, it is now negative gamma. For us as a futures traders, it make not a big difference. So please be very careful. If you be only in futures trader, or if you be only in stock trader, you can use the word negative and positive, but look always to the chart and see what the chart is telling you, and don't looking into the wording negative and positive. Don't get triggered from positive and negative. If you get triggered from positive and negative, look in the data behind what the data was telling you when there was the calculation, and not if you now open the chart and we are now 2% up, or I don't know, 2% down, or something like this. So it's a big difference, I think.
Yeah, but I think also, Patrick, if we are 2% up or 2% down, the fact that you are in a negative gamma environment could actually accentuate that move higher. Yes. So like the catalyst would be the news, the Tesla earnings, but basically the gamma environment could then help the price to move faster or lower, like for example.
Yeah, but what I want telling you in the simple basic is like, think about Fabio. I like the discussion now. So you see a one-to-one discussion with me and Fabio. All right, I'm a futures trader and the market is 2% up, and I see now negative gamma. Maybe people were short because they're thinking negative gamma. They're getting the wording negative gamma. They're thinking now we have to short. No, this is not the meaning. Negative gamma, positive gamma is basically on options, but this doesn't mean that you should go short or you should go be long. This is what I want meaning with this. Yeah. So this doesn't mean that you should go long or you should go long. You cannot take this as as entry signal for long, or you should not take it as entry signal for short. This is what I want to be clearly telling you.
Yep, absolutely. All right. Do we have more questions, guys?
Come on. Let's squeeze me and Fabio. Come on. I love the discussion anytime.
Let's see. No more questions. Okay.
I have a question, Fabio.
Yeah.
I don't let you go easily.
I
All
know.
right. So you was showing us the skew from the SPX and the QQQ. So why you was showing us the SPX and the QQQ? Is this based on possible hedging? And if you're showing us SPX and QQQ, is there some other thing, like if you're thinking about the Russell or if you're thinking about other ones, where we can also bring both together, like what you was showing us with SPX and QQQ?
So I think the reason why I looked at this morning is because, for example, we are going to prepare and we're going to have a session later on Tesla, right? So it's interesting to see how the market is repositioning differently on two assets that are highly correlated, but they actually are kind of opposite. So the QQQ is very tech focused. So this for me is interesting because a lot of participants are now bidding more on puts on the QQQ, but they're not on the SPX. So like the idea here is that it seems like there's more wariness in the tech space because of the earnings, where there's a lot of hedging activity going on the QQQ side, but not really on the SPX side. So that divergence is interesting to me to understand, okay, what is the market thinking about the earnings? So we're going to see Tesla tomorrow, but you have the big ones coming too. So it's going to be very interesting. And also like the elections are coming. So monitoring how the market is moving in those kind of like, and looking at the skew there can give you like a good idea of what's happening.